I'm a former investment and retirement advisor turned long term care specialist after working closely with my colleague Linda Carruthers for several years. This video is going to explain the basics that you need to know in order to plan for long term care. I'm going to explain what long term care is, the three questions you must be able to answer in order to plan for long term care, and then finally, help you understand how long term care insurance works and how it could help you prepare for the impact of long term care should you or a loved one need it. So I have a lot to share in this video. I don't want it to be too long. So without further ado, I'd like you to meet the Winsteads. Jim and Kathy Winstead are in their mid-50s, and they're an example of a family who comes to us for help with long-term care planning. Jim is a sales manager for a pharmaceutical company, and his wife Kathy is the assistant principal of their local high school. I'd also like you to meet Kathy's parents, Bruce and Ruth. Bruce had a stroke 5 years ago. Ruth became Bruce's primary caregiver until he passed 2 years later at the age of 79. So, of course, Ruth wanted to give Bruce the best care that she could, but with Bruce being quite a bit bigger than Ruth, it was difficult for her to help him around the house, help him get on and off the toilet, in and out of the bath, not to mention continuing to take care of everything else around the house that she was responsible for. And so Kathy started to see the physical and emotional toll this was taking on her mother. She suggested they hire a home care agency to help take the load off Ruth. Ruth was hesitant. She wanted to be able to care for her husband, but she had to admit that she needed help. So Kathy helped Ruth to find a good local home care agency, and she began receiving help around the house and caring for Bruce about 8 hours a day. And while this was very helpful, this was costing Bruce and Ruth about $7,000 per month, which they had not planned for. Now, through this whole process, they discovered that their Medicare did pay for doctors, therapists, medications, hospital stays, and other medical type of bills and costs. But they also learned that Medicare and even Advantage plans and supplements don't pay for non-medical care at home or in a facility. Care to help with getting around the house, getting dressed, bathing, even eating. This non-medical but necessary care was all considered long-term care and is not covered by any health insurance. They learned that Medicaid would pay for a nursing home, but only after they had depleted nearly all of their assets. And of course, this isn't what the Winsteads wanted for Kathy's parents. Thankfully, they had retirement accounts and were able to pay for the cost of home care for Bruce's remaining 2 years. After Bruce passed, Kathy could see that her mother's health and physical abilities had declined significantly over the last couple of years. Kathy and Jim live about an hour from Ruth, so Kathy was only seeing her 2 or 3 times per month, usually on the weekends. It became obvious to Kathy that Ruth was now in need of care herself. Because you see, providing care to someone who is chronically ill often makes healthy caregivers chronically ill. Providing care to someone who is chronically ill often makes healthy caregivers become chronically ill themselves. So Kathy ended up reaching back out to the home care agency and was able to secure 8 hours per day of care for Ruth. But Ruth could only afford this for about 1 more year without sacrificing the money she depended on for her necessary living expenses. And as her health continued to decline, she required even more assistance. Once she could no longer afford the home care agency, who would you guess became Ruth's primary caregiver? Kathy, of course. What choice did she have, right? And so Kathy, who again is an assistant principal at a local high school, began driving 1 hour to her mother's home each day after work, helping her with personal needs, preparing food and medications, doing what cleaning needed to be done, stayed with her overnight, and then left the next morning to be back at work. She typically stayed the entire weekend as well. She felt like she rarely saw her 2 teenage sons, one who is now a freshman, and the other in his senior year and would be leaving home in a few months. Her husband was supportive, of course, and he understood the needs of the situation, but he too was feeling the strain of rarely having quality time with Kathy and taking over all of the duties at their home. Ruth passed away 3 years after her husband. Kathy was, of course, distraught at the loss of her mother, and she was thankful that she had spent so much time with her that last year. But if she was honest, she also felt a little relieved. Now, of course, she was a wonderful daughter. She did what needed to be done, but that season had been uniquely challenging and emotional for everyone. One thing Kathy was certain of, she wanted a plan in place that would protect her sons from going through a similar ordeal with herself and Jim. So she and Jim scheduled a meeting with us. They saw that providing the necessary care had cost her parents hundreds of thousands of dollars, and they realized that it could have cost much more than that. And so they wanted to create a custom designed plan that would pay for and help manage their long-term care should they need it and take that burden off their sons. They wanted a plan that would take away the risk of paying for insurance that might not be needed. So we designed a plan that, if care wasn't needed, returned more money than they had put into the plan back to their sons. It was also important to them that the cost of their plan wouldn't increase over time. They had heard of people's long-term care insurance increasing in price so much that they could no longer afford it. So we made sure that couldn't happen to them. They were excited to learn that using these types of plans meant that if they needed long-term care, they had been able to get it for truly pennies on the dollar. Rather than having to spend $1 for every dollar of care, they were spending around 30 cents or even less per dollar of care. Most importantly, they enjoyed the peace of mind that their sons would still be able to help supervise their care and make important decisions, but they would never have to become their caregivers. They could just remain sons. And so I hope that gives you a glimpse into long-term care. So for the rest of the time for this video, I want to help you understand how you can begin to plan for long-term care yourself. And of course, the obvious place to begin is reviewing what is long-term care. So long-term care is non-medical personal care. It's due to physical or cognitive impairment, and the need for long-term care can be caused by an accident, by an illness, or of course by the normal aging process. And long-term care is designed to keep people safe and maintain independence. That's truly the purpose of long-term care, to keep people safe and help them maintain as much independence as possible. Long-term care most often occurs in one of three settings, either at home, in assisted living communities, or in a nursing home facility, although there are a few other settings where care can be received. And long-term care can be provided by formal, trained caregivers, as through a home care agency or an assisted living facility, or it can be provided by informal or non-professional caregivers, such as a spouse or an adult child, a family, a friend, a neighbor. Really anyone can provide some type of long-term care. So when it comes to planning for long-term care, there are three initial questions that we encourage everyone to ask themselves. Number one, you may never need care, but if you did, how would it affect you or your loved ones? You may never need care, but if you did, how would it affect you or your loved ones? Now, if you're taking notes, I encourage you to jot down a quick response. If you're not taking notes, this may be a good time to pause the video and grab something to write on, actually. I should have said that earlier on, but I would encourage you to write down these questions and really think through them. So again, how would needing long-term care affect you or your loved ones? In our experience, the three most common reasons people plan for long-term care is number one, to avoid becoming a burden to loved ones. This is most people's main reason, main incentive here. Number two is to protect their financial security. And then number three is to have maximum control and choice of the type and location of care they receive. Do any of these reasons resonate with you? If so, write them down. Write down which of these stand out as a concern that you have and a reason you'd be planning for long-term care insurance. Number two, second question, is if you were to need care, what could it cost? What could it cost? Now, don't worry, I don't expect you to know the answer to that question, so I'm going to help you out on this one. We'll begin by looking at the averages. So on average, long-term care costs around $60,000 to $100,000 per day, depending on the type of care, the location of care, the level of care being needed. And on average, a person needs long-term care for 2 to 4 years today. Industry experts expect the cost of care to increase at about 3.5% per year on average. And so that means that the cost of care will double in about 20 years from now to around $120,000 to $200,000 per year. And so that means that a 3-year claim today could cost $180,000 to $300,000. And in 20 years from now, it could cost $360,000 to $600,000 or more. And so while these numbers are helpful, they really do help us plan. The problem is that it's not enough to simply plan for the averages. And here's why. 1 out of 7 retirees will need long-term care more than 5 years. This isn't 1 out of 7 people who need long-term care. This is of all retirees, 1 out of 7 will need long-term care more than 5 years. Again, 1 out of 7. We also know that 1 out of 5 women and 1 out of 10 men over 65 will have a cognitive impairment. That's a lot more. That's a lot like 1 out of 7 if we think about it, right? And so I will share with you that for me personally, this specifically is an area that I feel very passionate about. I suspect that we'll see an increase in cognitive impairments and that most people are not prepared for the impact that this will have on themselves and their loved ones. And that's because the average cognitive impairment claim lasts 8 years. And so for today's near retirees, this could cost over $1.5 million down the road when they are most likely experiencing symptoms and needing care from a cognitive impairment. Above average claims can easily cost $2 to $3 million. And so this is why I'm so passionate about this topic. You see, I've worked closely with many financial planners and investment advisors over the years. I've heard and participated in a ton of conversations about the risks of market volatility, and increasing taxes, and those are real concerns. But for most families, I believe this is the biggest risk that's rarely talked about. Even many long-term care specialists like us are content to help families protect themselves from average risks and then just move on from there. I'll be honest, I can't do that. I want the people that I work with, that we work with, to at least know that this is a real risk and that they need to think beyond just the averages. This isn't a 1 in 10,000 situation. This is a 1 in 7 situation. And that's why I'm really thankful that you're giving some time. You're taking time now to educate yourself and begin planning and thinking about this topic. So the last initial question we encourage everyone to ask is, if you were to need care, how would you pay for it? And as we've just seen, this can be a pretty big question, right? But it's truly not a complicated one, because there are only 3 options to pay for long-term care. There are only 3 ways to pay for long-term care. Number 1, Medicaid pays for long-term care. Now, not to be confused with Medicare, which everyone receives when they turn 65 in the U.S. Medicaid is the health insurance program provided by the government for people who qualify by having low income and or low assets. You don't have to be 65 to qualify for Medicaid. But for a single person to have Medicaid cover long-term care, you have to spend down your assets to about $2,000, excluding your residence. That's in most states. That's not everywhere. That's in most states. If you're married, then a spouse can keep a little more money, but it's still a fairly small amount that has to be spent down too before Medicaid will kick in and pay for care. And again, the details vary a little bit state by state. So in most states, Medicaid will only pay for long-term care in a nursing home setting. That means that if someone is relying on Medicaid, they will have no choice but to receive that care in a nursing home, even if they don't necessarily need that level of care. And so while Medicaid can be a really valuable safety net for people who need it, it's not the outcome that most of us are wanting, for ourselves or for our loved ones. The second way is to simply pay for long-term care yourself out of your income and or your assets. And that's what people do before they qualify for Medicaid, is they have to pay for it themselves. And then if they get down to that asset level or income level, they can qualify for Medicaid. This is the default. If you don't have another plan in place, this is where you are. You're planning to pay for it out of your own pocket, out of your own income, out of your own assets. And then the third way is to purchase long-term care insurance, which can pay for some or all of your long-term care costs. That's it. These are the only 3 ways to pay for long-term care. So I hope you'll notice what's not on this list. Health insurance and Medicare, Medicare supplements, and Medicare Advantage plans do not pay for long-term care. These programs can cover non-medical personal care briefly for a period of time, but only do so for, again, a short period, usually 100 days max, and usually less than that in reality. They do not continue to pay for ongoing long-term care. You'll also notice that veterans' benefits are not on the list. Many veterans believe that their long-term care will be paid for. Unfortunately, that's a myth. There are some veterans programs out there that offer some financial support for long-term care if the veteran financially qualifies. But the assistance is fairly small, and most people will not qualify for it. So for all intents and purposes, veterans should not plan to receive any special assistance paying for long-term care. Now, since most people don't want or plan to rely on Medicaid, that leaves us with just two options for more discussion: paying out of pocket yourself or considering long-term care insurance. So it's easy to understand paying out of pocket for long-term care, right? You simply pay for it yourself. But there are some important questions to ask yourself if you're considering this option that I want to walk through with you now. So number one, could you afford to begin paying $5,000 to $10,000 per month for an unknown period of time? Could you afford to begin paying $5,000 to $10,000 per month for an unknown period of time? And if you did, could you maintain your lifestyle and pay for care? If the answer to these questions are no, then you would likely need to access your assets in order to pay for care. That's what happens to a lot of people. They don't have the income. They don't have the extra $5,000 to $10,000 a month or more to pay for care. And so they have to go to their assets. And so which assets might you have to liquidate? And so this could be savings, retirement accounts, second homes, other real estate investments, annuities. Anything really that you have could be sold, and often is sold, in order to pay for long-term care. But what if the market value of your investment portfolio is down when care is needed? Are you okay, locking in losses in order to pay for care? What would be the tax consequences of liquidating your assets? Would there be capital gains taxes or even ordinary income taxes if the money was coming out of a retirement account, an IRA, or a 401k? And then lastly, does it make sense to pay $1 or more after taxes, losses, and or liquidation costs for $1 of care when you could pay around 30 cents per dollar of care? Again, does it make sense to pay $1 plus for care when you could pay around 30 cents or even less per dollar of care? All right, I said last question. That wasn't true. So finally, last question. This may sound harsh, but it's a serious consideration. Are you okay with the possibility of becoming dependent on your children or the government? Are you okay with the possibility of becoming dependent on your children or the government? When considering these questions, some people determine that they couldn't afford to pay for care themselves, and they decide to consider insurance options. There's another group who decide they really could afford to pay for care if they needed to, but they would rather not rely on that. They would rather look at the leverage that can be had through insurance options. So for the rest of the time, we're going to look at long-term care insurance. You see, long-term care insurance is the most effective way to protect your family, your finances, and your future. Just bottom line. And so for the rest of the time, I'm going to give you a brief overview of long-term care insurance. I'm going to show you how you can get more information and hopefully answer some questions that a lot of people have on this topic. So first, as you may know, there are two main types of long-term care insurance, and I'm going to explain those differences in a moment. But first, I want to talk about what all long-term care insurance has in common. There are really two main components to all long-term care insurance policies. There are a few other things that are important to know, but these are the two main things to help you understand how it works. Okay? So number one is the monthly benefit. The monthly benefit is the maximum amount of money that a policy will pay in a given month. So that could be $3,000, $5,000, $10,000, really whatever you choose, right? But that's the most they'll pay in a single month for a single person. And then the second piece is the total long-term care benefit. And so this is the maximum amount of money that a policy will pay for a specific person over their lifetime. And so that could be $100,000, $500,000, $1 million. And there are even some policies that have an unlimited lifetime long-term care benefit that you can't outrun or can't spend down. And so unlimited is a great option if you're concerned about a cognitive impairment, given that average claims are 8 years for that. There's also inflation protection benefits that can come into play and a few other features, but these are the main two things that it's important for people to understand as they begin learning more about long-term care insurance. And so before we move on to the differences, I want to lastly address some common questions, the 4 common questions that we get about long-term care insurance. And these are generally true about both types of policies we'll look at in a moment. And so first is, yes, long-term care insurance benefits are tax-free. And let me tell you, if not having to worry about getting $5,000 to $10,000 per month and how that's going to impact your income tax can be a huge relief. So this is a major benefit of long-term care insurance. Yes, long-term care insurance covers care at home, in assisted living communities, and in nursing home facilities. Care will be covered wherever it is needed, and you can move from one to the other. In fact, it's not uncommon for people to begin receiving care at home, then transition to assisted living. Some people end up going to nursing home. Wherever they are, the policy will follow them, within the U.S., and care will be covered. Yes, long-term care insurance can cover you in any state. So you can buy it in any state and then use it in any state. So moving around the country is not a problem. And then finally, yes, we can cover spouses and partners under a single policy. And this can be a very cost-effective way to protect two people. So if you're part of a couple, this should be a serious consideration, as it can save a lot of money versus having two separate policies. Now, as I mentioned earlier, there are two main types of long-term care policies. One is called traditional, and the other is called hybrid. You may also hear hybrids called asset-based or asset-linked. There's a few names. They're all essentially the same thing. Traditional long-term care insurance, it's the original recipe, the first type that came out, and it's really plain vanilla insurance, meaning that it's very similar to your auto or homeowners insurance that you're already familiar with. You pay a monthly or annual premium, and if you need care, there's coverage there for it, right? The policy has a total long-term care benefit, and it has a monthly benefit, just like we saw a moment ago. If care is not needed, you don't get anything back. That's how it works with your homeowner's insurance, your auto insurance, right? You don't get something back if you don't have a house fire. So that's an issue, and for some people, that's considered a downside. One other big downside for traditional long-term care insurance is that premiums can, and almost always do, increase over time. So premiums are not fixed, they're not guaranteed, they are likely to increase over time. But this is the type with the lower cost today, and so it can be a very cost-effective way to protect yourself against the impact of long-term care. And so when it comes to traditional policies, many people, they didn't like that premiums increase over time. They wanted to have something that was fixed, that was known. They didn't have to worry about it increasing. Many people also didn't like the idea of the policy being use it or lose it. I mean, let's be honest, because the likelihood of needing long-term care is much higher than the likelihood of auto accidents. It's much higher than the likelihood of home fires, and the cost can be significant. It's not a surprise that long-term care insurance costs more, than these other insurances that we are used to. And so for that reason, many people didn't like the idea of putting money into a policy, and then if they don't need care, they just lose it. They get nothing back. And so in the late 80s, a few companies created policies that solve those two problems. And so those are hybrids. Hybrid policies have guaranteed premiums that never increase and that give the money put into your plan back to your family or estate if care is not needed. And of course, in exchange for this, hybrid policies do cost more today. However, they can't, because they don't increase, it's often the case that they are going to be the less expensive option long term. And so because traditional insurance is pretty easy to understand, most of us are familiar with that and can understand it quickly, I'm going to spend a little more time explaining how the hybrids work. So hybrid policies get their name because they truly combine two policies into one. They are a combination of a life insurance or sometimes an annuity policy and a long-term care policy. And I actually like to use my mother's policy as an example. So my mother's monthly benefit for her policy is $10,000 per month. Her policy is a life insurance-based long-term care hybrid, and so she has a guaranteed death benefit of $250,000. So that's this base policy that you're seeing here. It's a $250,000 permanent life insurance policy. And so if my mother never needs care and passes away, then my sister and I will inherit $250,000. Now, if she ends up needing $100,000 of care, then this life insurance-based policy is what's going to pay out first. So that's going to start to spend down her $250,000. And so if she needed $100,000 of care, then $100,000 comes out and she passes away, then my sister and I would inherit the remaining $150,000. And so no matter what happens, at least $250,000 is coming out of the policy into our family. Okay. Now, so however, should she need more than $250,000, then the base policy or the life insurance policy would be spent down, and then she would move over into the long-term care, the truly pure long-term care portion of the policy. And in her case, there's another $250,000 of pure long-term care insurance, and so for a total of $500,000 total long-term care benefit. So to summarize that, she pays an annual premium that will never increase, and at least $250,000 and up to $500,000 will be paid out from her policy. And it was very important for her, or to her, that her premiums were guaranteed and that she wasn't potentially paying for something and getting nothing in return. I will say, if I had it to do over again, this policy was done years ago, and if I had it to do over again, I would have opted or strongly encouraged her to opt for the lifetime benefit. That's the only thing that I regret about how we structured her policy. And as you can see here, hybrid policies have a lot more flexibility in how you can fund your long-term care plan. So whereas traditional policies only accept an annual or a monthly premium that lasts the rest of your life, hybrid policies can be funded using IRA, 401k, 403b funds. You can use the cash value of existing life insurance policies that may not be needed anymore, or annuity contracts that may not be needed anymore. Or you can use a lump sum of cash. You can do a lump sum kind of cash reallocation, which I'll show you in a moment. And even a combination of these is also options. So there are many people who have limited income, but they have more assets. And so a hybrid policy can make it easier for them to get the long-term care protection that they need. And so I want to give you an image, a picture of the one-time reallocation. This isn't something everyone does. A lot of people like this option, but I want you to see what that could look like. And so this can be a great way to once and for all cover the long-term risk. And so I often ask people the question, if you needed care today, what money would you use to pay for it? Okay, so let's say they're in their mid-60s or something like that, and if they needed care today, what money would they use first to begin paying for care? We're assuming they don't have insurance, right? And most of the time, they'll mention some portion of their savings, whether it's savings at a bank or CDs, a conservative investment account, or some portion of their IRA. This is the money that most people would use first to pay for care. And so then I talk with them and I showed them how they could go ahead and earmark or designate a portion of that savings for long-term care, and then use insurance to turn that money into 3 times or more, the amount for long-term care. And the best part is that they can do this while still maintaining control of the money, meaning they could still access it if they needed it. It's not just gone. And knowing that what was put in, and often more than was put in, will go back to their family or estate if care is not needed. And so this really allows hybrid long-term care insurance, to create a no-loss scenario. Whether care is never needed, whether an average amount of care is needed, whether $1 million worth of care is needed, or even if you change your mind and you need the cash instead, hybrid long-term care insurance can work for you under any circumstance. It really eliminates much, and sometimes all, of the financial risk of purchasing a long-term care insurance policy. Forgot to mention, so if you're thinking about it, looking at this, the idea, again, is to take a small portion of a portfolio, and that allows you to protect the rest of the portfolio. So a lot of people will look at taking 5 or 10% of their portfolio, purchasing a policy one time, realizing that that's going to protect all the rest of their portfolio if care is needed, or at least that's the intent, especially with a lifetime benefit. That is a likelihood. Okay, and so as we come to the end, I do have a few pro tips to help you get started. Number 1 is don't wait for retirement to plan for long-term care. Most people don't know this, but many companies allow their employees to access their 401k or 403b accounts once they reach age 59 and a half, even if they're still employed. And so, again, a lot of employers allow this, but few of them advertise it or make that known to their employees. Not because they're trying to hide it. They just don't make employees aware. I don't really know why, but I have seen this over and over and over, in my years in this industry, that a lot of people have access to money they don't realize they have access to. And so this can open up a lot of new options for people who may not have the surplus income to purchase long-term care insurance, but whose retirement accounts could be used and thus protecting the rest of their portfolio. And plus, this can be done in a way that doesn't create a big tax bill. So bottom line, you don't have to wait until retirement to begin planning for long-term care. Okay, pro tip number 2, we love to collaborate with your financial team to find the best solutions for you. We frequently bring our expertise to the table along with your financial advisors, your CPA, other insurance professionals that you work with and trust to ensure that everyone has looked at the big picture and created a plan that works. And then last, It's easy to put off planning for long-term care, but the cost of waiting can really be massive. Of course, the cost of insurance increases with age, but what a lot of people don't think about is the risk of not being able to qualify for the coverage is always a possibility. In fact, I talk to people at least once a week who call in who are interested in getting long-term care insurance and something in their health history, whether they're in their 30s, 40s, 50s, 60s. Obviously, the older, the more likely. But I've seen it at every age that something has come up and they're no longer able to get the insurance that they want and need. And so I encourage you, don't take that risk. Give yourself a deadline. Give yourself the next 3 months to get your plan into place, regardless of how you choose to pay for it, and let us help you get started with planning for long-term care while your health allows you to have the most options possible. So, final question before we wrap this up. Final question: what would having a plan for long-term care do for you and your loved ones? What would having a plan for long-term care do for you and for your loved ones? At Long-Term Care Consultants, we provide planning and insurance custom designed to pay for and manage your care. And so if you would like to schedule a free one-on-one consultation to look at all the long-term care insurance options available to you, take the next step by completing our pre-screened form by clicking the button below this video. Our expert team uses this form to understand which plans you qualify for and which one may best meet your needs. And so then once you submit it, we'll reach out to you and we'll schedule a meeting to discuss options. But this allows us to have a much better idea of what are going to be the best options for you before we ever even get on the phone. Long-term care insurance is the best way to protect your family, your finances, and your future. Take the next step by completing our pre-screened form below.